again and welcome. This is Robert Schein, Managing Director, Partner of Blanke, Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is May 2nd. We're already to May of 2023, and let's talk about the three topics that are moving markets. Actually, there's more than just that, but let's get right to it, and thanks for watching. So we've had market sell-off earlier today for a good reason. There's a lot of sort of clouds building of uncertainty, and the uncertainty then always, almost always, breeds the opportunities and the volatility with it within the markets. And we can see that right now. Markets have actually come back by the time I'm filming this a little bit midday on this trading day. That being said, we had in the last 24, 48 hours, a lot of headlines. Janet Yellen, the U.S. Treasury Secretary, essentially said the X date, or the date that there's no more gas left in the tank for the U.S. to pay their bills. She moved that date up. So originally it was thought to be the first week in June, maybe second week in June. Everyone's trying to sort of gauge that from most recent tax collection, and that's really what helps us really put a number to it. She didn't quite specifically say if there's 50 billion, 100 billion left in the general account to pay the bills. But what she did say is that has to be moved up to June 1st. So it's political pressure on basically, the move right now is putting pressure on Washington and the White House, as well as we have the Congress agreeing to disagree. And this is not a new thing. This is a continuing sort of saga. We had this default, a technical default in 2011, and markets had the reaction back then. But the risk of default will increase as we get closer, once hopefully cooler heads will prevail as we get closer to that deadline. But was Janet Yellen pulling forward the timing of this to put pressure on House Republicans so they could cave in terms of the debt ceiling increase debate without spending cuts? And ultimately, no one really ultimately knows. We do know that on June 15th, there's another tax collection. So if there is gas in the tank to make it through, right, interest payments, Social Security, Medicare, title, entitlements are key right here. But we also have May 9th is expected to be a confrontational date of sort of where the two sides will meet to improve sort of their, or consolidate, or just dig in even further on their political sides. And it's unlikely that Senator McConnell is to intervene with President Biden and Speaker McCarthy, as they have to resolve their issues first. And our sense is that they will come to a deal, but probably has to get a lot uglier before it's resolved. And ultimately, spending ceiling needs to be increased for all the obvious reasons. But the political argument is that the U.S. will default and the debt ceiling will not be raised. So we think it's more politics than anything else, as the U.S. has more than enough cash flow to pay interest payments. Even though the debt ceiling is not raised, the Treasury will continue to pay interest, in our view. And there's also estimates out there, but roughly about 120 billion of the government spending may be halted. If that happens in the month of June, then that could have a negative impact on the GDP of the U.S. Shrinking in terms of its spending if it's not quickly resolved. So that's the update on Janet Yellen's comment. Did she say it intentionally to bring and put pressure back to Congress? In the next 2 weeks, we're going to find out more and more. So this is going to be a continuing sort of conversation. And I suspect we're going to see more of this early on. We did get some good economic data today, the JOLTS report, which means ultimately, if you followed along, I've talked about the jobs numbers, sort of the jobs opening versus the jobs or versus somebody actually looking for employment. And the JOLTS number is basically, as I remember, if you recall, I've talked about there's 2 openings in our economy for every 1 person looking. And that number now just got revised basically to the worst it's seen and since April of 2021, which means instead of 2-to-1 ratio, we've got a 1.6, so 1.6 people or jobs opening versus, fighting after that 1 person right now. So that number's coming down. That then leads us to the Federal Reserve. We expect and anticipate in the next 48 hours, there's a 2-day meeting of the Federal Reserve for their May meeting. We believe that we will see a 25 basis point increase. So interest rates will rise in the next couple of days here. But there's a challenge there. It's going to put increasing pressure on the small regional banks. if you recall, you can get a 4 to 4.5, maybe even 5% on the U.S. Treasury. And that's what we're seeing, the influx of money from the banks. And in fact, let me show you this real quick. This is bank cash as a share of their liabilities relative to 2019. And ultimately, what you're seeing is the black line are small bank cash, and the blue line are large banks. And then you have the all banks is the red line. But ultimately, you see right here that they're being drawn down in the black line, the small regional banks, as we saw. This is our third or fourth year to date. We're seeing a huge influx from the small regional banks, money coming over into our custodians, Fidelity and Schwab, and then we're putting them in CDs, we're putting them in treasuries. And so that's going to keep continuing to put pressure as the interest rates rise. That's going to be that tension on the small regional banks we're going to continue to see play out. This is the lagging effect. So this is a chart that basically from Apollo that says it takes about 12 to 18 months for the Fed to actually soften the labor market. As I talked about before, that's what they're trying to do. They're trying to bring that tension in the labor market back more into balance. Therefore, the wage pressure for corporations and for individual small business owners gets lower and lighter in terms of that entrenched inflation. And so if they could impact the labor market and slow the economy, and you're seeing also by the small regional banks lending less to small business owners are going to be less likely to go out there and spend money because capital and cost of capital not only has risen, but now it's also more scarce, if you will. So there's a lot of sort of brakes being put on the Federal Reserve, and ultimately, if you look at the unemployment rate when it goes down, it essentially is the Fed funds rate here is in green, and this is the history of the Federal Reserve. And just showing how when they raise interest rates, historically speaking, there's a lag effect of right here. And right here is where you get the turnaround of the unemployment picture. This is unemployment, the unemployment rate, and it starts ticking up at the end of the Fed tightening cycle. And these are all the historical data points, even going back to 1954. So this is what the Fed's trying to do. They're trying to basically say, okay, we'll stop raising interest rates once we see that unemployment rate tick up. And we could see that sooner than later. And as we see the banks right there. Now, the household sort of cash right there. Remember, there's still $1.7 trillion left of excess savings and personal savings from COVID, because there was 2.3 of additional sum of money that went out there to small businesses, to individuals, and ultimately this is showing that we've only dipped into 900 billion, so there's 1.7 trillion left, and that's part of the inflation problem, is that extra liquidity. And finally, this is kind of interesting, counterintuitive. I kind of like to throw it in there because this is the diversification of economy, and sort of this is a we actually got a huge research report that I'll go more into, but this is the University of Michigan report showing that confidence is building in home buyers and home builders, believe it or not, in the real estate side. And this is interesting because if you think about what's coming down the road, which is higher interest rates, but they've relieved a little bit, home buyers are now saying, hey, wait a minute, they're waiting for the next shoe to drop with the real estate market going down 10, 15, 20%. And the first 6 months of this year, that hasn't happened. Now, there has been a reduction in terms of pricing and asking pricing in real estate, but it hasn't been like that big 2008 moment that a lot of consumers have been waiting for. Now, Rob, why would that be? And why is there now a turning around sort of on the real estate side? Well, there's two interesting things. Fewer people are listing their home in a down market, right? So if your home is going to fetch less than what you thought it would be, you're like, listen, I got a 3% mortgage or no mortgage. I'm just going to ride it out and I don't need to list. So that means that there's fewer listings. That's increasing the demand. And how do I know that? Well, the average offers received per property is starting to recover. So we're seeing on the real estate side 3 offers on every one home sort of listed right now, which is just astounding that this number has turned around. Again, low inventory, builders low inventory. We already saw that report a couple weeks ago when all the home builders reported, and they actually did quite well. and their confidence. People are like, okay, well, wait a minute, I can adjust to a 6% mortgage. Maybe I buy less of a house. Maybe I get a better deal. But it's interesting to see that people waited for the next shoe to drop for the first 6 months of this year in real estate, and we really haven't seen that ultimately play out. That's our update today. Again, we're going to have a full report on what the Federal Reserve is going to be doing. We fully anticipate a 25 basis point additional rate hike later this week, and it's going to pump the brakes on the overall economy. So we're positioning accordingly. And that's our update for the day. Thanks for watching. And again, like, subscribe, share with friends and family, and hope it's educational for you and you learned something today. Take care. Have a great day.